Okay, like the other patterns we've discussed, the Doji is considered a single candle reversal pattern. However, unlike the others, it can be considered either a bullish or bearish pattern depending on where it's found on the chart. Obviously then it's considered a bullish reversal if it occurs at a market bottom, and it's considered a bearish reversal if it occurs at a market top. But where's the real body? Well, imagine for a second how a candle with a real body does look. For example, a bullish green candle. In fact, here's one I prepared earlier. What we have here is the open at the lower end of the real body, here, and the close at the upper end of the real body, here. Now imagine if the open was a bit higher and the close was a bit lower. A bit closer again, and closer again till the open is the same price as the close. That's it. So a doji has no real body, but it's still a candle. It just looks different because the open is equal to the close. Does it need to be exactly equal? Well, no, nothing's exact in trading, but use some common sense. They just need to be really close. The point is that if it looks like a doji, it is a doji. The setup for a doji needs to be a trend. So for a doji to act as a bullish reversal pattern and signal a reversal at a market bottom, it needs to exist within the context of a downtrend, with confirmation of the pattern being price trading above the high of the doji. More conservative traders may seek a close above the high rather than just price trading above the high. And for the doji to act as a bearish reversal pattern and signal a reversal at a market top, it needs to exist within the context of an uptrend, with confirmation of the pattern being price trading below the low of the doji. More conservative traders may seek a close below the low rather than just price trading below the low. What about a sideways trend? Certainly you will find many doji candles within a sideways trend, or area of congestion. Typically though, a doji pattern within a sideways trend can tell us very little about future direction of the market, so ignore them. Look for them as a potential reversal from an established trend only, either an uptrend or a downtrend. Let's look at the psychology of the pattern now to see who is in control, the bulls or the bears. A doji indicates a tug of war between the bulls and bears in which neither party was dominant. Price was driven up from the open by the bulls, but driven back down by the bears. And at some stage through the life of the candle, price was also driven down below the open by the bears and driven back up by the bulls. In the end, neither party was dominant and price ended right where it began. So in this pattern, the doji, neither party is stronger. The doji represents indecision. And this is a powerful signal. Indecision in the market often precedes a change in trend to either a sideways or a reverse direction trend. Consider an uptrend. By definition, the bulls are stronger, driving price to new highs. Suddenly we have a candle showing indecision. The bulls are no longer dominant. While there's no guarantees, confirmation of the pattern by price trading below the low of the doji could be a powerful signal, alerting you to the possibility of a halting of the uptrend, and then leading to either a commencement of a period of sideways congestion or perhaps reversal to a downtrend. Consider as well a downtrend. By definition this time, the bears are stronger, driving prices down to new lows. Suddenly we have a candle showing indecision. The bears are no longer dominant. Once again, there's no guarantees. However, confirmation of the pattern by price trading above the high of the doji could be a powerful signal alerting you to the possibility of the end of that downtrend, leading then maybe to a period of sideways congestion or reversal to an uptrend. We have three common variations of the doji. Note that in all three cases the open and close are equal or almost equal, which is what defines the doji. On the left here we have the common doji, with the price moving both above the open and close to form a higher high and below the open and close to form a lower low. The center example is called a gravestone doji. In this case the open and close are also the low price, so price opened here at the low, moved up to highs and back to close again at the low. Considering psychology again, there is still ultimately a balance between the bulls and bears. Neither party was able to dominate the battle, resulting in the close right where it opened. However, given that the initial move was conducted by the bulls, and this was then countered by the bears who drove price back down, we can consider this a potentially more bearish signal. As such, you'll usually find the gravestone doji at a top reversal, more often than a bottom reversal. The pattern on the right is called a dragonfly doji. In this case, the open and close are also the high price, so price opened here at the high, moved down to lows, and back up to close at the high. Once again, there is a balance between the bulls and bears. Neither party was able to dominate the battle, resulting in the close right where it opened. However, given that the initial move this time was by the bears in a downwards direction, and this was then countered by the bulls who drove the price back up, we can consider this a potentially more bullish signal. As such, you'll tend to find the Dragonfly Doji more often at a market bottom. Let's look at a few examples. Hopefully these show up clearly on the small YouTube videos. Firstly, we have a Google daily chart, an uptrend, interrupted by a significant gap down and stall at the 500 level, break down below that level to a Doji, which alerted us to a false breakout when price traded back above the Doji and recommenced the uptrend. So in this case, it allowed for an ideal exit for those bears trading below the breakout, below the congestion, and below the 500 level. It allowed us to get out at break even, or at least to minimise any loss when price traded back above the high of that Doji. Alternatively, it offered an ideal entry for those bulls looking for an indication of resumption of the upward trend. And to show that this is not just a daily chart phenomenon, for those of you who trade really long term off the weekly charts, for example, here's the Google weekly chart. An established uptrend with a Doji. However, price doesn't trade below the low of that Doji, so there's no confirmation. Another Doji with no confirmation, so no reversal. Up to a high, retracement, retest of that new highs with the Doji right at the top. In this case, confirmation of the pattern through price trading below the low of the Doji leads to a downtrend, which comes all the way down to our old friend the Doji, with a couple of spare Doji thrown in for a good measure. Once again, price trading above the high of this Doji at the market bottom leads to a change to an uptrend. And for the shorter term traders, Google 5-minute chart. In this case, we have an uptrend leading right to a group of 3 Doji candles at the top, an impenetrable wall of Doji. I don't know what you call a group of Doji. I have one friend who refers to it as a spa bath of Doji, but whatever it is, it clearly shows indecision. The wall of Doji here halts the uptrend and brings price back down to new lows almost an hour later at another Doji. Just the singular variety this time. Confirmation through price trading above this Doji did not reverse price, but rather signal the start of a couple of hours of sideways congestion. And a good reminder is shown here. A Doji within a sideways move provides no indication of potential future direction. The sideways move itself is already a demonstration of balance of power between the bulls and bears. There's already indecision. Further indecision through the Doji provides us with no new information.